What if I told you there's an investment that has quietly outperformed the stock market for over 50 years? Not crypto, not some secret hedge fund strategy, not Tesla, not Amazon, not even Berkshire Hathaway. I'm talking about an asset class that generated an average return of 11.8% per year, while the S&P 500 delivered just 10.2%. Now that 1.6% difference might not sound like much, but here's where it gets insane. If you invested $10,000 50 years ago in the S&P 500, today you'd have around $1.2 million. But if you put that same $10,000 into this investment, $2.8 million, more than double. And the craziest part, most people have never even heard of it.
Never heard of it.
Your financial advisor probably never mentioned it. CNBC isn't screaming about it every day. So what is this investment? Why does it work so well? And why isn't everyone doing it? Stay with me. I'm going to show you exactly what this is, how it works, and how you can start investing in it today with as little as $100. Let's get into it. But before I reveal what this investment actually is, you need to understand something first. You need to understand why beating the market is so incredibly hard and why most people fail at it miserably. Here's a stat that should make you uncomfortable. Over the last 20 years, 93% of professional fund managers, people who get paid millions to pick stocks, failed to beat the S&P 500. Let that sink in. These are Harvard MBAs, people with Bloomberg terminals, insider connections, teams of analysts working around the clock, and 93% of them couldn't beat an index fund you can buy for $10. So what chance does the average retail investor have? You know, someone checking their Robinhood app on lunch break, picking stocks based on Reddit threads, or whatever Elon Musk tweeted this morning? Not great, and the data proves it. According to JP Morgan, the average retail investor earned just 3.6% per year over the last 30 years. Meanwhile, the S&P 500 returned 10%. That means the average person didn't just underperform, they got absolutely crushed. But why? Why is it so hard? 3 reasons. 1, emotions. People buy when they're excited, sell when they're scared. They buy high, sell low, the exact opposite of what you're supposed to do every single time. 2, timing. Everyone thinks they can time the market, get in before the bull run, get out before the crash. But study after study shows this is nearly impossible. Miss the 10 best trading days over a 20-year period, your returns get cut in half. 3, fees and taxes. Every time you trade, you're paying someone commissions, spreads, capital gains taxes. It adds up silently like a leak in your gas tank. So here's the truth no one wants to hear. If you're trying to pick individual stocks and beat the market, you're playing a game where the odds are stacked against you heavily. But, and this is important, that doesn't mean you can't beat the market. It just means you need a different approach. An approach that doesn't rely on predicting the next Amazon, doesn't require you to watch charts all day, doesn't demand perfect timing, an approach that has 50 years of data proving it works. And that's exactly what I'm about to show you. All right, it's time. The investment that has beaten the stock market for over 50 years is real estate. But wait, I'm not talking about buying houses, taking out massive mortgages, and dealing with broken toilets at 2 a.m. I'm talking about REITs, real estate investment trusts. If you've never heard of them, a REIT is a company that owns massive income-producing properties. We're talking shopping malls, apartment complexes, hospitals, and data centers. And the best part, you don't need $500,000 to start. You can buy shares of a REIT on your phone, exactly like you buy shares of Apple or Amazon, for as little as $50. But here is the absolute game changer. The reason REITs are a wealth building machine. By federal law, REITs are required to pay out at least 90% of their taxable income to shareholders as dividends. 90%, straight to your pocket. While the S&P 500 pays a measly 1.5% dividend on average, REITs regularly pay between 4 to 8%. So why exactly do they beat the stock market? It comes down to 2 forces working at the same time. Number 1, property appreciation. Just like a house, the buildings these REITs own go up in value over time. Number 2, rental income. People and businesses always pay rent, even during recessions. When you combine property appreciation appreciation with massive dividend payouts, and you reinvest those dividends, you create an unstoppable compounding machine. Wall Street doesn't talk about it because it's boring, long-term wealth building. They can't charge you crazy trading fees for it, but opinions don't matter. Data matters. So let me show you the actual numbers and why this strategy is so terrifyingly effective. Alright, let's look at the actual 50-year data. From 1972 to 2022, the S&P 500 averaged 10.2% a year. REITs averaged 11.8%. Now, a 1.6% difference might sound like nothing, but this is where compound interest gets crazy. If you invested $10,000 in the S&P 500 50 years ago, you'd have about $1.26 million today. But in REITs, you'd have $2.83 million, more than double the wealth from a tiny 1.6% edge. But here is the ultimate proof of why this works. Look at the 2000s, the dot-com crash and the 2008 financial crisis. They call it the lost decade for stocks because the S&P 500 returned negative 0.9% a year. You literally lost money holding stocks for 10 years. But REITs, they returned 10% per year during that exact same decade. Why? Because even when the stock market crashes, people still pay rent. But before you go and put all your money into real estate, we need to talk about the catch. Because yes, there are risks. But you have to be smart about this because REITs are not magic money machines. And there are two main risks you need to watch out for. First is interest rates. When rates go up, borrowing money gets more expensive for REITs, and that can temporarily pull their stock prices down. The second risk is the sector not all REITs are created. Equal office buildings are struggling right now because of remote work, while data centers and warehouses are booming. So you can't just buy anything and expect to win if you want to start today. The easiest way is not by picking individual companies, but by buying a REIT ETF like VNQ or Search, which gives you instant ownership of hundreds of different properties with one single click. This is the ultimate hack for long-term wealth because it combines the safety of real estate with the liquidity of the stock market. And as the data shows over the long run, that is a winning combination every single time. The stock market is great, but if you want to truly amplify your wealth building, you need to look where most people aren't looking. REITs have the history, the data, and the cash flow to back it up. Do you own any REITs, or are you sticking to the SP 500? Thanks for watching, and I will see you in the next video.